All right. Well, thank you so much for joining us. We just want to give everyone a couple of minutes to kind of filter in. All right. We will get started. Feel free to interrupt us, ask questions. We're a small group. So unmute yourself and don't worry about interrupting us. We are used to it. You might hear us interrupt each other. That's just kind of our preferred method of communication. So my name is Rebecca Shepard. I'm a tax attorney. I'm here with Peter Huckabo, who is also a tax attorney, and we run the practice group of special credits at Frost Law. So prior to the pandemic, Peter and I got our roots in tax controversy. So we were working with small businesses and tax exempt organizations through compliance issues, whether it's payroll tax, 990 compliance, all of these different issues you could have with the government, sales tax, admissions and amusement tax, international, domestic, all kinds of things. But when the pandemic hit, we knew that our clients really needed some extra help in order to make it through those, in the beginning it was 2 weeks and then 2 months. And then, it obviously extended quite a bit in getting everyone to be able to continue their operations. So Peter and I started with PPP and then went into EIDL, FFCRA, and then finally with the Employee Retention Credit, the ERC. And what happened is originally you couldn't use those two programs together, ERC and PPP. But in December of 20, that changed and Congress said, okay, you can use these two programs together. You just can't use the same dollar twice. And that's really when Peter and I started looking at our clients to determine eligibility for the Employee Retention Credit. Once that happened, we kind of had a shift from going from defense, tax defense, audits and compliance issues and all those kinds of things into offense and how to get the best bang for your buck, from a frontward way of thinking of your organization. And that's kind of what this presentation is born out of, is a way to help you all, one, so you have more cash so you don't have compliance issues, but also things to think about in order to, increase your bottom line. So that is why we're here today. I'm going to kick it over to Peter.
All right. So just to be clear, this isn't an employee retention credit presentation, but we are going to start and briefly touch on some of the issues just because this has been so much in the news lately and the IRS is making a bunch of noise about it. So, the messaging really has changed quite a bit from the government. Early on, there was talk of ERC being this broad-based program, and there was a publicity campaign that the government was supposed to get out there to identify potentially eligible employers and make sure they were aware of it. And what you saw in the space was a whole bunch of newly formed shops opening up and processing these claims. And what happened starting in last October was they came out with a warning. Government said some third parties are taking improper positions related to taxpayer eligibility for and computation of the credit. So part of effective tax planning is, if this is something that you've done already and have concerns about the analysis, is being thoughtful in how to manage that. So the government followed this up with inclusion of ERC on their dirty dozen list, which is the worst of the worst tax schemes each year that they warn taxpayers about. That was in April. As of September 14th, there's now a processing moratorium on ERC. Government says they're not going to process any claims until the first of the year. They're still filing them, they're still accepting them, just not processing. And what they've done is they've also come out with a withdrawal program. And actually, as soon as this webinar is over, Rebecca and I'll be jumping on one that's produced by the IRS to learn a little bit more about that program. So again, part of effective tax planning is if you did something incorrectly and you need to fix it. So we just want to run through quickly to make sure you understand the theory of the case and some of the issues that I think are ripe for audit and places where some folks may have cut corners. So I'll throw it back to Rebecca.
Yeah, absolutely. So, like Peter said, the employee retention credit is the most lucrative tax credit we'll see in our lifetime. But it's also one, I think Peter's lines are always that it's really easy to do wrong and really hard to do right. And so make sure that if you've done it right. So how do you become eligible? The eligible employer is someone who is carrying on a trade or business during the calendar quarter for which the credit is determined, and either a significant reduction in gross receipts or a suspension or partial suspension of operations due to a governmental order. Significant reduction in gross receipts is the easiest one. So it's something to look at. Simple math, check your quarterly P&Ls and determine whether or not you had a reduction from 2020 to 2019 and 2021 to 2019. A 50% reduction in 2020 will grant you eligibility, and in 2021, it's an 80%, a 20% reduction in gross receipts. So it's easier to get in 2021. For both years, there's an alternative reference period where you get the automatic next quarter if you make that initial eligibility. For 2021, it's really important to consider because just with one quarter of being down 22%, your next quarter, you could be up 1,000% and you could get additional eligibility. And as we'll get into, the credit in 2021 is much, much bigger than it is in 2020. 2020, the most you're able to get is $5,000 per employee, which is 50% of up to $10,000 in qualified wages. For 2021, it's 70% of up to $10,000 in qualified wages per employee per quarter of eligibility. So one quarter alone is more than all of 2020, and 2 quarters obviously is almost triple. So the gross receipt decline is not very challenging, and most people can do on their own. The full or partial suspension test is very challenging, and it's where Peter and I spend most of our day. So an operation of a trade or business is fully or partially suspended during the calendar quarter due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings due to the coronavirus disease. The portion of your trade or business that is fully or partially suspended must be more than nominal, which is a facts and circumstances test. But the portion of the trade or business will be deemed to be more than nominal if the suspended trade or business generated at least 10% of the total gross receipts, or at least 10% of the total hours worked in the appropriate reference period in 2019. So pre-pandemic, because if something is fully suspended, you can't look and see how much revenue that generated because it's not there anymore. Obviously the analysis is simpler when operations are completely closed because you're looking at a finite number of revenue in 2019. We look at restaurants just because it's an easy example, but if indoor dining of your restaurant in 2019 is more than 10% of your gross receipts in Q2 of 19, then you're going to be an eligible employer in Q2 of 20. When things start to reopen and you're able to operate, that portion of your business is no longer fully suspended. Now you're talking about a modification on your operations. So this is a bit more of a challenging test because you're dealing with current day solutions. So you're looking at not just the indoor dining solution of 50% capacity and 6-foot social distancing and all of that. Now you're also looking at to compare the drive-through and carry out and DoorDash and all of those things. So now you need to check to see whether or not those restrictions have more than a nominal effect on your ability to provide goods and services, and that's still 10%. So that analysis can be really challenging because it's hard to know.
And I'll just say in the medical industry, and to put a theory of the case out there for medical. I mean, you did see a lot of states and localities cancel non-medically necessary or elective procedures early on. That's sort of your indoor dining, right? You're trying to understand pre-pandemic, was that a more than nominal portion of my operations? And you're going pre-pandemic and you're testing that. Then eventually they say, okay, you can do these elective procedures, but you have to do X, Y, and Z, physical distancing, issues with waiting rooms, enhanced cleaning, those types of things. You have to then understand during the pandemic how that affected your day-to-day operations, what changed. You have to be able to say it was more than a nuisance, it was more than an inconvenience, it was more than nominal. And whoever you're working on this with, should be pushing you to quantify and to identify, what would you show an auditor should they show up to want to look into the claim. There is a third method of eligibility, relatively limited and specific, but by definition, this employer began operations after February 15th, 2020, and their gross receipts were less than $1 million. What is this? It's a situation where somebody took a risk, started a business during a pandemic, survived, not only survived, but had employees come Q3 and Q4. So this is only available for Q3 and Q4. It's the only way to claim the employee retention credit for Q4 of 2021. The catch is they're capped at 50,000 per quarter. So it's 100,000 overall if you're recovery startup business. Just briefly, some special issues. I'm not going to go into detail on these, but the takeaway is that this is built on existing tax law. So there are ideas of controlled groups of corporations and affiliated service groups. In the medical industry, think about physicians practice group being different than nurses and other staff in a different entity. You can't get cute and play around with structuring. There's going to be many situations where you're going to be considered a single employer for purposes of the credit, and you've got to make sure you're doing the analysis correctly accordingly. Same with controlled groups is the idea that the parent subsidiary or even brother sister controlled groups, the credit changes and the rules change depending on if you have multiple member controlled groups. There are special rules with majority owners and deemed owners. Changes the way that the qualified wages are computed. So you need to know not only who owns the business and how it's structured, but you need to understand relative percentages of ownership and family members. And it goes relationships established by marriage, in-laws, and step relationships. So these are definitely going to be issues that the government will look at. If you acquired a business or a portion of the business during the pandemic, there's a safe harbor for what to think about gross receipts in that regard. And then just to start to wrap this up, if you haven't claimed the credit, just be aware there are some very real deadlines. Credits related to calendar quarters in 2020 are due, need to be filed by April 15th, 2024, and then add a year for credits related to 2021. The assessment statute expiration date, so this is how long does the government have to come back and take a look at what I filed. It is 3 years from the filing date of the original return. So calendar quarters related to 2020 need to be audited by April 15th, 2024. The first 2 quarters of 2021 need to be audited by April 15th, 2025. There is a different rule for quarters 3 and quarter 4 where the government gave the IRS an additional 2 years. So it's actually April 15th, 2027. So, and then just briefly, because one thing we have seen, both as an audit issue, but also some of these processors fail to mention, specific in the statute, principles similar to Code Section 280 Cap C are pulled in. What that means is that if you get a credit based on wages paid, you lose the deduction for those wages up to the amount of the credit. The deduction is an income tax principle. So what this means is that you're going to have to go back and amend your 2020 and or 2021 business income tax returns to the extent the practice is a pass-through partnership or an S corp. That is going to generate amended K1s, and the individual owners are going to have to file amended returns as well on their 1040s and pay tax. So this is not a tax neutral thing, but the way the computations work is the amount of the credit, it's generally worth it.
Before we get into the next set of things, I think there's is the next slide still ERC or is it something else?
No.
Before we get into the next set of things, I just want to say, one, if anyone has any questions, this is the time to ask. And again, unmute yourself if you want to put it in the chat. You don't want to unmute yourself, like that's fine. But either is totally fine. Also, if you filed for the employee retention credit, which I know most people, most organizations have, lots of businesses have, I should say. And you don't have clear dates of eligibility, and you don't have substantiation, and you don't have a solid theory of your case, now is the time to put that stuff together. So what we always do, and what I tell people when they call me and they filed with somebody else and they're like, Rebecca, I just don't know what to do. Okay, what you need first is to determine what your eligibility dates are. So what dates were you did you suffer from a significant decline in gross receipts, or were you restricted due to those government orders? What is the government order? Does, OSHA general duty clause count as a government order? We would say no. We really don't agree with those that are saying that it does. So what is the government order? How is it restricting you? And then how do those restrictions have either more than a nominal effect on your ability to provide goods and services, or how are they more than a nominal portion of your revenue that's fully suspended? Work through that eligibility. Understand the dates of your eligibility. So March 12th, 2020 through February 15th of 2021. Well, for 2 quarters of that, I have my significant decline in gross receipts. And for the other 2 quarters, these were the restrictions. And, because of social distancing, because of sanitization, I wasn't able to provide the right services to my clients, to my patients. And I had to space out how many people I saw in a day, what Peter was saying as far as like building out your theory. It's so important to do that now because a lot of files are being reviewed before checks are going to be issued. And audits can obviously happen even when checks are issued. But if you have filed and you have not received payment yet, now is the time to really build out your file and make sure you feel comfortable in the positions that you've taken. Peter and I are happy to have these conversations. Feel free to give us a call and we can talk you through it. But that's just something now to think about, because if you're filing and you get checks and you're not sure about your theory of eligibility, you're going to want to understand like how to move forward.
All right. So the rest of this is some other credits, a discussion about recognizing income and expenses and playing around with that, and then talking about some structuring things that you may be able to do. The work opportunity tax credit is another COVID era, or at least it's been extended because of COVID. So it was initially set to expire at the end of 2020. The Relief Act, the same one that sort of flipped ERC on its head, actually extended it to December 31st, 2025. The credit itself is available to employers for hiring and employing individuals from certain targeted groups. Those targeted groups, as you will see, we'll run through them, have faced significant barriers to employment. The credit generally is 40% of qualified wages. Generally speaking, qualified wages are capped at $6,000, and so 40% of 6,000 is 2,400 per employee. But it can be as much as 9,600 per employee, and that's just because, you know, in this one example, a qualified veteran with a service-connected disability and at least 6 months of unemployment within the 1 year preceding the date of hiring, well, the qualified wage cap is 4 times the amount as the $6,000 rule, and so the credit's worth. Credits are offset. They offset federal tax liability dollar for dollar. So it's not a deduction. It is an actual credit, which, you know, other than the fact that it's standing in the shadow of ERC is a pretty valuable credit. So if you're hiring folks from some of these targeted groups, it's worth, you know, taking a look at. We'll share the slide deck, or I actually think we already did. So it'll be available to you. I'm not going to go through the details of each of these, but who are the qualified groups? Well, a qualified 4A recipient, a qualified veteran, qualified ex-felon, a designated community resident, vocational rehabilitation referral, qualified summer youth employee, qualified SNAP benefit recipients, qualified SSI recipient, long-term family assistance recipient, qualified long-term unemployment recipient. I missed one. I did not. So those are the groups of people that are the members of the targeted group. So again, $2,400 to $9,600. They're going to make you work for it a little bit. So you do have to, excuse me, I got to move the screen. You do have to obtain a certification from a state workforce agency. So every state has a workforce agency. There is someone who you submit this form to say yay or nay. We agree they're a member of a targeted group, or they're not. And this needs to be done you know, on or before the day that the job offer is made. The pre-screening notice must be completed by the job applicant and the employer. The pre-screening notice is Form 8850. It's a short Google search away and hosted on the IRS's website. There's four dates that must be provided on there. So you need to memorialize the date that the applicant gave information about being a member of a targeted group, the date the applicant was offered the job, the date the applicant was hired, and the date the applicant started the job. The employer must request this certification by submitting that notice again to the state workforce agency within 28 days of the individual beginning work. And after that, government's going to say, yeah, we agree, no, we disagree. How do you claim it? It's Form 5884. Work opportunity credit, which rolls up into Form 3800, and then that Form 3800 is going to be attached to whatever business income tax return you file. If you're filing on a 1040 Schedule C, it goes there. Partnership 1065, C Corp 1120, S Corp 1120S. The catch here is that it's not a refundable tax credit. So that was what was so advantageous about the employee retention credit, is that, you know, it can pay off your tax, but then it goes beyond and the government actually sends you a check. In this regard, it's not refundable, but you can carry it, any unused WOTC credit, back 1 year and then forward up to 20. So chances are you'll have an opportunity to take advantage of the credit itself.
All right. There are no questions right now. Does anyone have any questions about WOTC or ERC? Happy to go through them. Bonus depreciation, we can also talk about. So in general, you have income for your business, revenue, right? Money that comes in the door, and then you have expenses. You buy stuff. Normally, for something you're putting into your business, that expense is going to be depreciated over a course of its useful life. which so for like a printer is probably 3 years or something like that. And so you take a portion of it each year. Bonus depreciation allows you to depreciate it right away. So bonus depreciation is a tax incentive that allows a business to immediately deduct a larger percentage of the purchase price of an eligible asset. Bonus depreciation is only applicable to certain businesses, to certain business assets, including only property with a useful life of 20 years or less. You also can't use it. You can't have owned it before. It can't be your car, your personal car that you then put into use for the business. It can't be a car of your husband or your wife. It can't be in somebody that you is related to in any way. The asset was not formally owned by a component member of a control group. The asset's basis is not figured in reference to the adjusted basis of the property when under the ownership of the seller. Basically, it can't have like been connected to you previously, right? The Tax Cuts and Jobs Act, the TCJA, implemented a bonus depreciation schedule and phase out. So assets acquired after September 27, 2017 and before January 1, 2023 are entitled to 100% bonus depreciation, and then it goes down 20%. So for this year, it is 80%. Next year, it'll be 60. And then it phases out in 2027. What typically happens is Congress will come up with a new plan to reinstate in some way, but as of now, that's not the case. So regular depreciation continues after that. Section 179 is a different way of hurrying up that depreciation. And the reason people do this is because they want to pay less tax this year. They don't want to pay less tax next year. So most people, not all, because your situation might be different, but most people want to maximize as much as they can in the current year. So Section 179 is similar and allows for immediate expense deduction for purchases, but is limited to items such as cars, office equipment, business machinery, and computers. The maximum amount that could be deducted in 2022 was $1,080,000. And the states might be a little bit different, so pay attention to your state. The items purchased must be used for business purposes more than 50% of the time to qualify as a Section 179 expense. Now, we probably should have said this in the beginning, and I apologize if I didn't, but this is not meant to give you advice to go fill out your tax return tomorrow. It's meant for you to then have a broader conversation with your CPA or tax professional to say, oh, hey, like, I want to make sure I'm maximizing my depreciation as much as possible. Oh, I think I might be eligible for WOTC. What can I do here? So these are supposed to be like ways to issue spot, and we'll get into some more items like that in a little bit, but just to kind of make sure we're all on the same page here. So Section 179 expenses can be more flexible with timing than bonus depreciation rules because a taxpayer can elect to save certain assets for future tax breaks or claim only a portion of the cost and defer the other portion for a future tax year. So you don't have to take it all up front. However, there's strict rules, so make sure you're following them. And then again, you know, the limit for Section 179 expenses. I'll briefly talk about the research and development tax credit. This is one that gets a lot of scrutiny at the IRS, but it's something to think about, even if you are not a tech company or an engineering company. If you developed an app to interface better with your clients, your patients, if you're working better, if you implemented some other technology in order to help you in your practice, then it's possible that you might be eligible for the credit. So it's a federal tax credit available to organizations that invest in qualified research and development activities. The credit provides dollar-for-dollar cash savings for performing activities related to the development, design, or improvement of products, processes, formulas, or software. So number one is a 4-prong test. So number one, you need to have for permitted purpose or qualified purpose business component test. So the activity intended to develop new or improved business components, so improve function, performance, quality, or reliability. It could be a product, a process, technique, formula, or software. So elimination of uncertainty. So the activity intended to eliminate technical uncertainty concerning capability, optimal methodology, appropriate design, or process or product improvement. process of experimentation. So you're going to go through a lot of iterations of this, right? You're not going to just create something and have it be good. You're going to keep going back and forth, back and forth, back and forth to make sure that you're using it properly. Different technologies, several iterations, modeling and simulation. And then finally, it has to be technological in nature. So engineering, physics, chemistry, computer science, or other disciplines. If you think that your practice is going to be eligible for the research and development tax credit, definitely talk to your tax professional. There are a lot of specialized firms that handle that kind of work. And if that's something you want us to put you in touch with, we're happy to send you a referral for that as well.
All right, so choice of entity and tax strategies. I'm going to primarily talk through the tax reasons to choose one of these versus another. There are many reasons to favor one versus the other. We're talking about federal tax generally. Sole proprietorship is the most basic, right? There's no difference between you and your practice or the business. This is really the only one that I'm going to say carte blanche that you do not want to be, but that's for a non-tax purpose. Well, I guess it's for tax purpose too, but for non-tax purposes, you want to have some sort of entity in place to protect your personal assets in the case that something may happen. I am aware of several physicians that practice as a sole proprietor, and unfortunately, no matter how many times I tell them to knock it off, that they're putting themselves at risk. They haven't taken my advice. So if that is you, please take my advice and get at least an LLC. So single member LLC is the next step up. For tax purposes, it's a disregarded entity. So the government, federal government at least, pretends that it doesn't exist. And so that's why a single member LLC is still filing on a 1040 Schedule C. This is a pretty tax inefficient structure, both a sole proprietorship and a single member, since it's disregarded. You're going to pay income tax and self-employment tax on your net business income. Now you get a little bit of a deduction, but it's still not very efficient, and you're paying a lot of tax when you don't need to. The next choice would be a multiple member LLC or a partnership. This is also pretty tax inefficient, but it's very flexible when it comes to what you can do, deals with other partners, priority distributions, those types of things. So again, for non-tax purposes, you may choose to do this, but you're going to pay, again, you're going to pay income tax on guaranteed payments. You're going to also pay self-employment tax on your business income as well. So inefficient all around. Then the next is choosing between the two corporations. There's a C corporation and an S corporation that refer to subchapters of the code. C corporations have gotten better over the years. TCJA brought the rate down to, I think, 21%, which is better. But the age-old issue with C corps is there's double taxation. So the C corp itself pays tax in a year over year as income and expenses are analyzed each year. But then when dividends come out to the individual stockholders, tax on dividends is paid by the individual member. Now, right now, dividends are dividends that are qualified dividends are taxed at a favorable rate of same as a capital gains rate, but you still have that double layer of taxation. So it's not the most efficient. It's gotten better. The most tax efficient entity remains the S corp. It was before TCJA. It still is now. That said, you've got to work for it a little bit. So one issue with an S corp is you must pay yourself a reasonable salary, and reasonable salary is a tough thing to consider. It is not a bright line test that we can point you to say yes, that's reasonable, or no, it's not. You're trying to analyze what someone who's similarly situated, role, job in a similar community is paying themselves. I can tell you the answer is not $5,000 a year, because the motivation here is going to be to pay yourself the least amount, because the sort of trade-off here is that the net business income that is passing through from the S corp to the individual is only being subjected to income tax and not to self-employment tax like it is in a partnership, sole proprietorship, or single member LLC. So there is an additional expense, right? You've got to get payroll set up. You're potentially, having a payroll processor, and paying them. You're filing an additional tax return because it's a pass-through entity. All that said, the tax savings are, substantial and worth looking into. And I should say, these elections are relatively easy for the most part. Well, they're called check the box elections. So it's a matter of filing forms and making sure that the IRS is changing status.
So, other fun effects of the TCJA is it caused your Schedule A deductions to be limited. So, for those of you that used to be able to write off $40,000 of state and local income tax and property tax and all these things, now it's capped at $10,000. So, bluer states got hit a little bit harder than red states because of how much state and local tax and property taxes people pay. So governors of those states were scrambling and trying to figure out ways to benefit business owners and keep them in their state. So they were very creative and came up with a lot of different plans. One was calling state and local tax charity, so that way it could be considered a charitable deduction. The IRS did not go for that one. The other one was to allow pass-through entities, so partnerships and S corporations, to pay tax on behalf of the owners. So an S corporation that has one owner, Peter's the owner, he can pay the state and local income tax from the corporation, and then it's an expense on the corporation, and it is reduced in his K-1. So say he was supposed to make $100,000 on the K-1 in 2022. When you do the workaround, say he pays $10,000 in state and local income tax, then now his income is $90,000, and that's what he's paying tax on. So it's a direct benefit for business owners to be thinking about this. And great news, though you guys did it a little late, Missouri enacted a SALT Parity Act in 2022. So you all are able to do this. It's literally called the SALT Parity Act of 2022, and it will allow you to pay your state and local tax, SALT, from your business, and then you take that, you have less income at the end of the year. Make sure you look and determine exactly how you need to claim it, be eligible. Usually there's some sort of declaration you need to file, and then start paying it. If there's time in 2023, it's certainly worth looking into if you haven't done it yet. If not, definitely start with 2024 and make sure that you're, getting as much in your bottom line as you possibly can.
There's really no reason not to do it. You're going to pay the tax one way or the other.
It's just less tax. Does anyone have any questions about that? That's like the easiest way to save money on taxes that you could find, literally. Okay, well, thank you so much for joining us today. If anyone has any questions and they didn't want to ask it during the webinar, please feel free to reach out to us outside of the webinar. Peter and I have spent thousands of hours on the employee retention credit and PPP and EIDL and FFCRA and all of these things. And we are happy to answer your questions and have these conversations about those products. Not products, but about those credits. If you have questions about the research and development tax credit or the WOTC, we don't do that type of work, but we are happy to provide referrals for people that do. That's it. Thank you so much.